That was JPMorgan CEO Jamie Dimon earlier today weighing in on the succession plan at JPMorgan. That was an exclusive interview with our Leslie Picker. Joining me now at Post 9 to talk about that bank and Mr. Dimon and the setup for bank stocks is Mike Mayo, Wells Fargo Securities. It's good to have you back.
Thanks for having me.
What, Dimon, 68? He's 68 years old?
Well, yeah, he has 2.5 years left or so on his contract. So
Are you thinking about it yourself, succession at JPM, and the way you think about the future of this bank?
I'd say a lot of the institutional investors that I talk to ask me about succession at JPMorgan.
They do?
They absolutely do. And especially with the recent op-ed in the Washington Post by Jamie Dimon, his CEO letter this year in the annual report. He's talking about America, the comments in the press, would he go to the government service? And on that exclusive CNBC interview that you guys had today, he was asked not once but twice, would he consider government service? And he says, I like what I do. What I read in that is...
He said that three, 4 times.
Maybe 3 or 4 times. He didn't give an answer. So if he's going to be Treasury Secretary, the next Fed chairman or something like that, he didn't say no. And so that certainly comes a little more to the fore during an election period like that. And taking a straw poll among investors, nothing scientific. It's like, how much would the stock go down if Jamie Dimon were to leave?
Yeah, what do you think about that?
The answer is like 5%, which would mean $25 billion off the market cap, which would make Jamie Dimon the $25 billion man.
What about the financial sector in the here and now? We have, rates to take into consideration. We have worries about the economy as well. So how do you see that?
Look, the main course for banks is still good over multiple years. You're looking at a multi-year inflection point for revenues and earnings starting sometime later this year in 2025. Having said that, no dessert for bank investors in the month of August, maybe a little bit longer. And that dessert's been taken away. There's new data points. The unemployment rate went up a little bit more. The interest rates are a lot lower than people expected. The R words come back, recession. And so you have to recalibrate your expectations that those extra capital market revenues that you thought you might have gotten over the summer, maybe you don't get that extra. Those extra spread revenues from higher interest rates and what's called fixed asset repricing, you might not get that. The extra reserve releases for problem loans, forget about the reserve releases right now. So you're still inflecting, but maybe just not as much as before, and you have to readjust to that. And so I'm saying it's a speed bump in my multi-year thesis here and a little bit more short-term caution.
What are your expectations about, since you brought it up, capital markets? I mean, David Solomon, Goldman Sachs, was pretty positive on it when he last spoke. Rich Handler of Jefferies put out what I thought was one of the most bullish notes regarding the current state of capital markets, if not the most bullish that I've seen.
There are tremendous multi-year tailwinds for capital markets, especially that X factor of private equity, trillions of dollars to get put to work, pent-up demand over a number of years, a lot of liquidity, but this hiccup in the market, could put a monkey wrench in that in the short period coming ahead. And the other thing we have to, literally, before I go to sleep at night, when I wake up in the morning, are there any accidents in the market given such volatility in recent days? So far, I don't see any big ones.
Nor does Jamie Dimon, by the way, who was asked by Leslie about, whether there's a recession or not. First thing he went to was credit, said it's fine. Now, obviously, things could get worse at some point, but in the here and now, he doesn't see it, and the credit markets would suggest they're backing that up.
I would agree. That's why the main course for banks is still good. And the one data point is corporate bond spreads relative to treasuries are still close to the relative low point. They're 100 basis points over. Back in 1998, they were like double that. By the way, bank bond spreads, the largest bank bond spreads, are still close to relative low points. So the $7 trillion investment-grade bond market is kind of giving a yawn, and the equity market's kind of freaking out. It's the opposite of, say, the global financial crisis. Remember, the fixed income market was a much more forward indicator than the equity market. Equity market, all of my colleagues, we were slow to the message. In this case, the fixed income market's kind of just saying, ho-hum.
Is there a message today or this week in the fact that, JP Morgan's green on the week, given the turbulence that we've had? Goldman Sachs is positive on the week. Citi's down 4 1/3%. Why?
This is simply a Pavlov's dog. Okay, the bell rings and you salivate, you have a hiccup in the market and you say, all right, who's likely to win? Those who have won in the past, Goldman and JPMorgan, who's likely to lose? Citigroup. I think that's simply a knee-jerk reaction based on their performance of the last 10 to 20 years. I don't think that has any bearing it has some bearing to reality, but I wouldn't read too much into that. We'll see the results in the third quarter. And by the way, if Citigroup navigates yet one more industry issue like this, that could help their revaluation. Still my number one pick, but with the caveat, short term, we have a little more caution for the whole group.
What about regionals, or maybe it's better to ask you about super regionals? That's basically what you cover when it comes to those kinds of stocks. What should I think about that now? Well,
I think there's an issue with lower rates. Be careful what you wish for. Everyone said, let's get lower rates. Banks are often treated as a cyclical play, so the Fed cuts, you get a rally. But that net interest margin, it's going higher, I think, for the banks, but probably not as high as you thought before, because if you're reinvesting those maturing securities in yields that are 70 basis points lower than they were a month ago, then that inflection's not as great as it was before.
All right, it's good to see you. Thanks for being here. It's Mike Mayo, Wells Fargo.